Hi, and welcome to Talking to Investors, the Impact Startup Negotiations podcast. Today, I'm speaking with Daphne Postma, who's a former fund manager at Triodos. We discuss things like the best win-win contract clause to boost your startup's valuation, the one thing to avoid at all costs if you don't want stakeholders to hate you and ruin your exit, or how compromises can mess up your investment deal and really make you look bad in the process. So, how important it is to find smarter solutions than cheap compromise. Daphne has worked with about 20 startups and has lots of great stories to share. And as always, if you enjoy these interviews, please like this video and subscribe to my channel. All right, let's begin. Hi, Daphne. Thank you so much for joining me today on Talking to Investors, the Impact Startup Negotiations podcast.
Yes, thanks, Ben. Happy to be here.
Daphne, today we'll be talking about transitions. And I thought, let's start with an example. You recently managed the exit of Einhundert. Who is Einhundert and what do they do?
So Einhundert, that was basically one of the portfolio companies we invested in with the Triodos Energy Transition Europe Fund. Basically what Einhundert does is make it easy for project developers to make multi-tenant apartment buildings more sustainable. So they cover both installation of solar panels, provide asset financing, but do that all the way up to providing the invoices for the tenants for their energy bills.
And when you were helping Einhundert with their exit, you noticed that something's different than, let's say, 5 years ago.
Yeah, so there are some interesting proof points, I think, in this specific exit. So first of all, I would say the maturity of this company, it became rather early in the stage of their growth that a party like Arcus that now acquired Einhundert shows its interest, but it is actually something we see wider in the market. We see it in different angles, that infrastructure partners are interested to acquire companies like this at an earlier stage. That's one thing. The other thing is also the energy transition sphere itself. So also climate tech, we see that it's caught on a lot of interest, and there's also different reasons and different motives for parties to jump on this market. One of them is, of course, the clarity that it's now a real necessity, but also the fact that we've seen it from it being more easy to get to the required returns with this type of investment.
Thanks. And we'll delve into other kinds of transitions that are happening in the impact space later on in this interview. But before we do, I think there's a burning question on the minds of most listeners right now, which is, who is Daphne Postma? So tell us a bit about your background in investing, please.
Yes, of course. So initially, I actually started out my career as a lawyer. So I started out in telecommunications and energy or regulated markets. Why? Because I thought that was a really good skill to have. Actually, never really with the goal of being a lawyer the rest of my life, but it was a really good basis. Now, what I found out during that period is that first, making an impact was really, really important to me, and that was not the specific place to occupy myself primarily with that. And secondly, the energy transition was just such an interesting sector and only just starting up. So in my next move, I went to Eneco, a Dutch utility, where I could make the combination of both energy transition, and it was a company that was very much looking for making an impact by increasing sustainable energy production in the mix. Now, at Eneco, I made the switch from being a lawyer to being an investment manager, basically because I thought it was much more interesting when we were involved in negotiations to be at the steering wheel and to be really looking out for those companies and those startups which were interesting to us than just be at the table as an expert. And then I went from Eneco to Triodos because there I could really see the combination of investing both in projects, so really tangible Google Map type of assets, and also start up something new, being investing in growth equity throughout the energy transition. So that's that's how my turn came about, from being a lawyer to being an investment manager. And when I was at Triodos, I also found out that the entrepreneurship is something that really, really pulled at myself as well. And that's also one of the reasons that I make my step to be self-employed right now.
Because you just mentioned entrepreneurship. Is it true that entrepreneurs need certain kinds of special skills, maybe communicative skills or also strategic skills to succeed, and that maybe for most entrepreneurs these skills are the same? If you had to say, what are the three superpowers that make successful founders successful?
I think one of the things is always wanting to understand any aspect of your own business. So always be interested into why does something work or not? Why would I do it one way or another? And that doesn't mean that you should stall endlessly on such questions, but I have to say that at the end of the day, it makes you more flexible as well if you really understand the drivers of your business. Then I think, especially at a startup in a relatively early stage, but also as a scale up, sales is hugely important. So you can have everything right and not have any form of commercial understanding, and you'll never get anywhere. So I think that's one very important trait, which is important to look for in a founder. And like I just said, also flexibility, and also that also includes being able to take input in.
You also mentioned that you enjoyed the negotiation aspect of being more involved directly in the negotiations. I'm sure you've been in a few tricky negotiations, right?
Yeah, so I think, like I said, it's one of the interesting parts, and it's definitely also one of the more tricky parts. So there can be a few reasons why negotiations can stall or can really become very difficult. So I think one situation we had was where we started off with a term sheet. We had a certain discussion, and at the end of the day, following DD, which had already taken a very long time to get through, we needed to adjust our valuation downwards. That's never a fun or easy thing to do. At the end of the day, no one's really happy if that's the case. But it had a quite specific reason of cash in the company not being able to count as such due to the nature of the business. And I remember sitting at the table. In this case, it was 3 women on our end and 1 guy on the other end, where we came into the discussion, and it just took I don't know how long. And at the end of the afternoon, he was just screaming, "Cash is cash," and repeating it over and over again. So that was something which turned out quite tricky. And I think one of the elements which is really important to bear in mind is to also think about the negotiation style and tactics on the other side of the table. So here we had a bit of a clash of a very rational us saying, well, I'm so sorry, but we don't go through the model and it just doesn't leave any more space for this. And we can turn it upside down, but that doesn't help. But he was coming much more from a situation where he was used to horse trading. And he just really didn't feel the idea of detailed financial modeling. So at the end, if you're right, that's not really enough to get to a solution. You need to have understanding on both ends and also understand each other's style. And another thing, which I've had a few times, which is quite difficult, as soon as people feel out of their depth, they tend to not be able to make any decision except for no. Or they come up with ridiculous compromises which don't really help anyone. So I guess also often it's the investor which has most experience if you get into contractual negotiations, and founders often have less experience. Then if you get into such a situation, I wouldn't try and bluff yourself through such contractual discussions, but just get some reference from someone you trust, be it a paid advisor or people from your network. And also don't be afraid to ask for time to do so or ask for a timeout, because at the end of the day, that's best for everyone and there's no shame in it.
In previous interviews, I've often come across expressions like, there are no stupid questions. It's, good investors should take for granted or do take for granted that founders don't have as much experience and there will be things that they don't understand. So ask.
Yeah.
Alina Klarna in the previous interview said,
Mm-hmm.
never just cross your fingers and hope for the best. Make sure you understand everything.
Exactly. Exactly. I think that's true both for your business itself as well as these contractual discussions. You can get really caught up in trying to devise any really grim situation and engineer that out until the very end. There will still always need to be a certain amount of trust, and I think that also only can really exist when both people at the table feel they're at a bit of a similar information level.
That means part of it is founders actually reaching that informational level, right?
Yeah, exactly. And I mean, in that situation, I've also have been at places where, as an investor, you try to explain or you try to be able to be the person that hands them that information. That can work up to a certain extent, but you can reach a level in negotiations where people get a bit stuck. And then it really helps to have that outside reference, or perhaps even advise founders to get their own outside reference in order to get ahead.
What are communicative skills that founders have who are good at asking questions?
I guess one of the most important communicative skills there would be to listen to the answer. Well, of course, you need to be optimistic, perhaps bordering on naivete, in order to be able to start your own business and basically to be successful in it and to continue to try. And you need to be, well, at the same time, you need to have a certain conviction of being right. But that's, of course, something that helps you, but can also work against you very much. So I guess it's something which is also more often said. It's great to have such a self-convinced founder, but you really do need to be open to some feedback as well. Everyone will run into situations where they either don't know it or might just be wrong, and then added experience to the table is something that can help you.
Would you say there's a balance that founders need to find between self-confidence on the one side, but not being overly self-confident to the degree where they can't listen to other people anymore?
Yeah.
The ability is to doubt.
Yeah, and to be open to have a reasonable discussion. And I think especially if you get into multi-stakeholder negotiations, at the end, you need to have everyone on board. And part of that journey is also that throughout the period in which you have investors on board, they also feel taken along and listened to. Aside from the fact that you can actually gain from the experience that you might hear.
We tell founders they must be confident all the time, and I think there's also space for intelligent self-questioning doubt, right? In the right moments. Of course, they shouldn't be going around, oh no, I'm not going to make it.
Yeah.
That's not the kind of doubt we're talking about. But smart doubt. Is there such
exactly? Well, perhaps that's a good expression, Ben. Smart doubt. I think it goes for anyone, and I think that's also something I learned, or someone told me early on in my career. Actually, when being a lawyer, someone advised me not to play the part of being a lawyer, but to just be a lawyer. And I think this is a sector in which that happens a lot. Founders playing the part of founder instead of being who they are and have confidence based on that and based on their own substance and knowledge and personality. But to basically build that on a role of founder. And it also goes for the other side of the table, I guess. Investors can have a bit the same type of attitude. So I guess in many roles, not playing the part, but just being it makes a lot of difference.
I have one last question about negotiations before we move on to the quite amazing topic of the impact investment landscape and transition. And this last question is, as an investor, you take on a certain amount of risk. And because of that, understandably, investment contracts have risk management tools.
Mm-hmm.
For example, certain rights that you have, certain obligations that the founders have, etc. Even to the point of board seats and things like that. So if you had to choose a favorite contractual risk management tool, what would it be?
Yeah, then I almost tend to say two, but I guess
Say two. Say two.
so. One of them is yes. So I think at this stage of a company, if you're investing, I think being part of the governance is really important, basically for both ends. I don't think if you're looking at seed or Series A stage companies, you shouldn't get money on board which doesn't do anything more than be money. Probably that'll work against you. So if they have more to offer, you probably want to have them a bit closer by as well to be able to offer on that. And as an investor, I always say it's quite difficult to just hand over your wallet and then just see what happens at the end of the ride. So from the position, the type of investments I've done, that's always been the case, that I feel that that's been an add-on, added value, but also a necessity. And then the other thing is, of course, when you get into very difficult valuation discussions and you might really not get to a full conclusion at the end, I think actually a milestone approach with additional options or shares to be issued is something really interesting, because at the end of the day, that is a way of putting flesh to the bone. If you really say you're going to make this growth path, and I have really legitimate reasons why I think you're not going to, well, then just show it, and then and then you can pluck the fruits of it.
What would the clauses in such a contract look like then? They'd basically be meeting milestones, and then based on the milestones, what happens?
Yeah, so basically it could work two ways. So either it could be the case that you comply with a certain valuation, but if the milestones are not met, then basically you have a clawback, so you get more shares issued, and then that would go to the party that had the lower valuation in mind. Obviously, mostly the investor, or it could work the other way around, showing that basically valuation had to be higher, and then that would also be solved in certificates.
So basically, based on meeting milestones, shares trade hands.
Yeah.
Now, as promised to you and to the listeners, the hot topic of today is the impact investment landscape in transition. And of course, that involves quite a few components of this landscape, right? Transition to a more thematic approach, then the sectors themselves, then how investors perceive things like hard tech, et cetera, et cetera. You told me in a previous conversation that you perceive investors themselves transitioning to more of a thematic approach to investment.
It's the world has become a bit more difficult for VC. So money isn't as cheap as it has been. And parties really need to be more creative or add an additional angle in order to be able to both raise funds and to invest in a meaningful way. Basically, one of the ways in which to do that is thematic funds. And we see that, for instance, the energy transition is one of those hot topics where more thematic funds have popped up. In order to be able to absorb that, it's also a bit of a luxury that a sector should be able to do so, right? So it's also something we see that there is room for now. I think over the past 2 years, growth equity for energy transition tripled, and you also see that in the popping up of the thematic funds. So that's one thing, and I think it's a good thing for this sector because it's just quite complicated or complex, especially for climate tech. You need to understand more than just a typical SaaS model. And in my perception, we've also come a bit at the end of the period where we can get away basically with only having growth equity for that type of model. The very interesting SaaS applications that we see going around flexibility of the energy transition, flexibility of grids, and a lot of other things. They now really do need a proliferation of assets in order to be rolled out. And that's where we see that there's a bit of a difficulty. The other thing is that we really need hardware. So not only more of the assets that we know, but also new and more efficient assets in order to be able to increase the renewable energy and to be able to also work those SaaS models. So that means that the combination of the two becomes more and more interesting. And we see also more companies actually realizing that, and more investors knowing that this is actually something where you need to bring additional skills for. But in order to be able to invest in something like that, you need to have basically a track record as an investor. So if you're in the field as a company with such a climate tech or a combined asset/SaaS proposition, you need also investors that can understand it. And to search for those, they would basically typically have a diverse investor base. So the investment managers and the people involved should probably be of a diverse background, where that can be very helpful. Preferably they have some track record in the field, of course, because now seeing these thematic funds pop up, it can be with or without a track record, basically. So that's something to really ask about and look further into to understand whether they actually have this, or otherwise you're going to be their learning project.
So it's worthwhile for startups to actually do their due diligence on investors too, right?
Exactly. I think that's very much the case. So that's something to be wary of, I think. And then also had the patience of the capital. So even more so than in other sectors, if you're in technology development or if you're into a more asset-heavy model, then you're going to run into problems if it's a basically typical SaaS investor that doesn't understand that the risk profile is actually a bit different, and your time to cash break even will also be very different. So I think that's basically something which is getting more into the market, and this sector really needs this as well, this type of investor to become more active.
When we're talking about thematic approaches, there's of course different kinds of themes, right? Everything from energy transition to the agri-food sectors, to water management. There are some VCs that have, let's say, 3, 4, 5 investment theses. How broad or narrow would you say somebody's thematic focus should be? I mean, an investor's thematic focus should be. What would you advise startup founders to pay attention to?
Well, I think there can be a lot of, it can be very useful if you're active in more than one field, because you can also perhaps gone through a cycle or partly gone through a cycle in a certain sector and have those learnings for another one as well, and still be active in the first one. I do think it's helpful if there's overlap in the actual skills and the characteristics of that sector. For instance, biodiversity, energy transition, water transition are all very interesting topics where you could say it all has to do with making an impact and making some transition. But for me personally, for instance, biodiversity, I wouldn't claim to have an expertise on in the current situation. At the same time, for instance, water transition, I've been less active in so far, but there's a lot of characteristics from the energy transition which I think are now applicable to water. So first of them is the type of the parties active, the utility type of parties that you can see there, the type of transition that it needs to go through, which is both from an infra perspective as well as from an asset perspective, and an efficiency and a smart steering perspective.
Mm-hmm.
So there, I think there's a lot of overlap, which can be really, really helpful.
The other thing I wanted to ask you on the topic of transitions is, do you perceive that some VC funds themselves are changing their attitudes about certain aspects of VC, like the balance between return and impact or things like that?
Yeah. If you look at the parties in different growth stages, so first of all, VC and then also PE. For VC, I see specifically in the energy transition that the whole idea that VC as such, typical SaaS play, doesn't really get us there fully is more and more accepted. Mm-hmm. And I see VC players that really were focusing specifically or only had tolerance for SaaS models are now changing and accepting the idea that there might be an asset component in it. Mm-hmm. Because they also see that it's stalling a bit. So that's one thing. From my perspective, it's also interesting. It's just a bit of a different risk profile. There is a difference also between technology development and what I call the asset heavy approach, where you say our customers don't have room or appetite to have on their balance sheets renewable energy assets, but it's something where as soon as you're able to offer financing of that, being a startup, mm-hmm. you can really grow much quicker. But then you need to have a party to support you in that. But because you have this asset component with this customer, you have a position you're not as easily moved away from, which is a bit different from a typical software player. So I tend to say that even if in some ways growth could be a bit slower because there's just more to do to install assets and there's something you need to maintain as well. If those assets in itself are not very risky, because solar panels, we now really understand them and we don't think it's such a complicated play, then risk is also lower because you have this whole asset base and customer base, which doesn't move away that easily. Mm-hmm. So I think people are also more and more looking at the different types of risk profiles and absorbing them more as being part of their portfolio. Now, if we look at the typical PE firm, we see that their returns actually also require them to look into growth stages of company earlier. I mean, if the typical infra player needs to do a 10x return on its investment, then just stepping into an operational wind park or something doesn't get you there. Yeah. So they need to move.
I guess one of the main messages for startup founders is that if their startup is asset heavy, then they can also argue that it actually changes the risk profile for customer retention.
Yeah,
indeed. In a positive way. In other words, it reduces the risk of short customer retention spans that don't go anywhere.
Exactly.
Mm-hmm. Well, that's a very positive message. Thanks. It is. That's also maybe one of the reasons why some startups are thinking beyond VC, right? Mm-hmm. Also, we had a previous conversation briefly where you said, well, there's all these different forms of investment and it's actually good for startups to consider them as well. And maybe even sometimes VC funds to consider collaborating, let's say, for example, with grant or something like that.
Yeah, for sure. I think there's a lot of value in that because it also allows for a looking ahead further in the future. Mm-hmm. And basically also to speed up your growth rates by having additional, even with a bit of a different cost of capital, but by teaming up with different financing parties.
Mm-hmm. What would you say makes good combinations? For example, like VCs and grants, or what are other good combinations that you see as potential new structures out there?
So for this type of model, it can be the type of project finance player that, as within Triodos, within the Triodos Energy Transition Europe Fund, we basically combined those different profiles. So different types of capital with a different cost of capital. But those you can of course also find in different players with a different profile, which don't have it all mixed. So that's also why this type of move, and why I think also the exit for Einhundert was interesting, because it can feel too early to team up with a PE firm, but you can definitely early on already reach out to them. But same actually also goes to attracting senior debt for asset financing earlier on. I think that they are also opening up to having models that are scalable, but they also still have some work to do. So there are also a lot of explaining will go into that. And that's something where your investors might also be able to help you out with. Mm-hmm. For instance, we had a situation where you would like to attract senior debt for a certain customer portfolio of assets, where initially that senior debt provider was very much focused on cash flow, basically valuing on cash flow of each individual asset, where basically actually, if you think about it, trying in case of a default to sell individual installations that you would have with customers doesn't make any sense anyhow. That's not how it's going to work. So basically that's not something where the biggest value for them is in. So they need to also switch a bit the type of thinking that they have, understanding that default of customers, that's something you need to understand, how many customers of that company would be eligible for default or not, and really understand what are good securities for them to work with. So in short, to say what kind of combinations of financing might be interesting. So in combination with a VC player that understands the sector, reaching out and testing the waters with PE firms earlier on, so they can also help you provide junior debt for asset companies, and then also checking and teaming up with senior debt providers earlier on.
So there's another topic that kind of broaches on this. We've almost touched on it, but I want to dig a bit deeper because recently I've been reading a lot about the value of combining, if you're looking for a lead investor and a co-investor, combining an investor who has a thematic approach with a generalist, and what's the added value of using a generalist?
Well, of course, sometimes you can never know what kind of learnings across sectors can be of help. So I do think, in order to not get a tunnel vision too much and focus too much on digging deeper and deeper and deeper into the details of a business model, that can be helpful as well. So the combination is something I think for anyone can be useful. And on the other hand, it might also be that there's stricter financial discipline, perhaps, involved in a more generalist approach. Could be the case. That might be something which is helpful as well. But that also depends a little bit on the stage of the company, of course.
Thanks. And before we get to how to approach Daphne and how to reach out to you, there's one last question that I'd like to ask that really fascinates me because of the recent Einhundert exit. What would you say to founders preparing for an exit? What would they, what do they need to pay attention to during these multi-stakeholder negotiations that lead up to exits?
I think it's nearly impossible to get your governance airtight or to have all interests aligned at the very same time at an exit. So I think you should probably need to take into account that there's deviations in there. So you need to have some way to have everyone on board to do what's best for the company. And of course, you can say, a good investor always does so, but that at the end of the day, you need to be realistic that not everyone has exactly the same interests due to cap table structures or whatever reason there might be. So there need to be other reasons for investors to support you and your exit if that's what you're looking for. And one of the most important things is to take them along, to make sure that everyone is sufficiently aware of what's happening, aware of what a process is going towards. And I think I've seen different strategies in investments I've been involved with. So one of them was perhaps more coercion, and forcing everyone through a information asymmetry into a certain deal. And I've seen the more cooperative and more fostering a team spirit among the players at the table. Now, I think that the first one will very likely end up in some kind of game of chicken with very suboptimal results for everyone. And the latter is probably the best route to an exit where you can get the best for the company, and the investors within the framework of what's best for the company can also get their interests aligned.
And if you think that, mostly you'll have had a 5-year long, maybe even 7-year long relationship with those investors before the exit. The quality of that relationship, all those years before the exit, does that influence how the investors are going to make the exit happen for you?
Yeah, I think so. I think it's a bit of a strange parallel, perhaps, but I guess that same would be true in an inheritance. If people feel unheard throughout their life, or in this case, throughout an investment, chances are that they might, if they have the possibility to make the process difficult, to do so. So personal relationship and personal commitment and involvement throughout the whole period really is important.
Mm-hmm. I mean, in simple words, also, if the founder treats it as a transactional type of, you can't really say transactional relationship because it's a bit of a conflict in terminology, but treats most of the interactions as being transactional, then you're going to have a transactional exit, which is pretty much the investor looking out for themselves.
Yeah, and I mean, it does. We're all professionals, and at the end of the day, everyone needs to look after their interests, and that's just the job you have, either being a founder or an investment manager. But all the difference is just in the way in which you do that, and the way in which you're open to each other. At the end of the day, it's based very much on personal relationships, and taking those into account will just make the world of difference when entering an exit.
Is that because the quality of the relationship also defines how open you are with each other?
Yeah, so I also very much believe in that. Having everything on the table also makes it possible to get to the best win-win situation in the end. So I guess that also highlights a bit that my negotiation style wouldn't be purely a shark holding all cards against your chest, trying to get to the best result for you personally, because I think at the end of the day, in companies in this stage where every negotiation basically is followed by a longer term partnership, and it's a small market where you always get to see each other again.
Exactly.
It's very important to be right.
Thank you so much for this conversation today and for the interview.
Yeah, thanks. I enjoyed it a lot.
Yeah, me too. And finally, I'd always like to ask, how do you like people to approach you? Do you reach out via email, LinkedIn, personal recommendations?
Yeah, so I guess I'm open to receiving people on via LinkedIn. Mm-hmm. I think often it really helps if there's some sort of link throughout the network, of course. But yeah, I guess LinkedIn and perhaps also email would work.
And of course, you've got an exciting time ahead.
Yeah.
Being now self-employed.
Yes.
Any thoughts on where you want to take that? And not specifically maybe like I want to do this job or that job, but more generally, what are your goals that you're moving towards now? What would give you fulfillment?
Fulfillment would be for me to really broaden my view, both in the energy transition sector, water transition, but also viewing the different sides of the table in VC. So I've been very much on the asking side, the investing side, being the critical person from the outside. I think it'd be really valuable to have more insight from the other side. So if there's anyone I can support in that, happy to hear about that. And basically also to do what's fun. I think it's underestimated how important it is that the surroundings you work in are motivating and basically fun. So that's something I'm really looking forward to.
Thank you so much, Daphne.
Thank you, Ben.
Thanks for listening, and don't forget to subscribe and hit the bell button so you don't miss an episode. And please do share this podcast with any impact founders you know who might benefit from better understanding the investor mindset and from thinking about what that really means, impact. Let's start this discussion between startup founders and investors about impact in the spaces of circularity, sustainability, and regeneration. Thank you.